Canadian stocks might just beat US stocks in 2025. And everyone is busy talking about tech giants and Wall Street, but Canadian companies could be your secret weapon for your portfolio. And today I'm going to break it all down in simple language. So whether you're new to investing or you're an experienced investor, this video is for you. So as we all know, Canada is global resource powerhouse. Canada has oil, gold, copper, and fertilizer. They have all the resources. They aren't just raw materials. They are essential components behind technology and infrastructure we use every day. Also, the world is transitioning to clean energy, and Canada is leading the charge with resources like lithium for EV batteries and copper for renewable power grids. So this makes Canadian companies perfectly positioned for the future. And let me give you some real examples of the company that you need to consider to invest in 2025. So first up in the list is Suncor Energy, and they had an excellent year in 2024. Only in the third quarter, they earned Canadian $2.2 billion. And that's huge improvement to earlier in the year. And Suncor refineries operated at a 105% capacity, meaning they are running very efficiently and producing a lot of oil. The company also generated Canadian $2.32 billion in free cash flow, which means they can use to invest in growth or to return to their shareholders. The second reason is they have attractive dividends. They recently increased their quarterly dividend to Canadian 0.57 per share, and it's now at 4.62%. That's higher than average in the energy sector. And the third reason is it's undervalued stock, and Suncor stock is trading at lower price compared to its earning, with the PE ratio of only 7.56. And this is much lower than the industry average. And if we talk about their future, they are not just focusing on oil. They are investing in cleaner energy projects like renewable power and improving its oil sand operation to be more sustainable. What sets Suncor business apart is that they doesn't just extract oil. They also refine it and sell it as a fuel. So this vertical integration helps protect Suncor from big swings in oil prices. So for example, if crude oil prices drop, they can still make money from refining and selling fuel. And by 2025, they plan to produce between 810,000 to 840,000 barrels of oil per day. They are also expanding their renewable energy project to align with global clean energy trends. And this move shows that Suncor isn't just thinking about today, but it's building a foundation for a strong future. So this stock is great if you want to hold and collect dividend for the future. The second stock is Canadian Natural Resources. And one of the biggest reasons to consider CNQ is its long life, low cost reserves. Most of its oil production comes from oil sands, which are unique because they don't run out quickly and they have 50 plus years of reserves. They are also cheap to operate with breakdown cost of as low as $20 per barrel. And this means that CNQ doesn't have to spend a ton of money just to maintain its production. And as I said, most of its oil production comes from oil sands. So what exactly oil sands are? They are a mix of sand, water, clay, and a thick type of oil called bitumen. This oil is so thick that it doesn't flow like regular oil, so it needs extra work to be extracted and turned into usable fuel. But oil sands are important for CNQ. They hold a lot of oil, especially in places like Alberta, Canada. The oil from oil sands lasts a long time and is cheaper to produce once the setup is in the place. And if you want to understand in simple terms, oil sands are long-term and stable way to produce oil, which makes them valuable for companies like CNQ. Also, CNQ recently made a big move by buying assets from Chevron, including 20% of stake in Athabasca oil sands project. And this deal will boost CNQ production by almost 10%. It will add 62,500 barrels of high-quality oil per day at a low cost. They also has increased its dividend by 25 consecutive years. They recently raised the dividend by 7%, bringing the total yield to 4.8%. If we look into the future, world transition to renewable energy, but oil and natural gas will remain essential for decades. According to the forecast, global oil demand is expected to grow significantly, reaching over 120 million barrels per day by 2050. But with CNQ massive reserves and efficient operation, it's perfectly positioned to meet this demand. The third stock in the list is Barrick Gold. So Barrick Gold is one of the biggest gold mining companies in the world. They just doesn't focus only on gold. They also mine copper, which is in high demand for things like electric cars and renewable energy system. So the mix between the gold and copper makes Barrick a more balanced company than others just gold mining sectors. If we talk about their financial health, they has one of the strongest financial position in the industry. Talking about their dividend, the yield is around 2.5% and they also been buying back its own share, which tells investors that the company believes its stock is undervalued. So when the company buy back their own share, this indicate that the company believe its stock is undervalued and investing in itself is a good use of money. So it's a way of signaling confidence in future performance. And also gold prices have been rising, especially during times of economic uncertainty. And because gold is seen as a safe investment, this trend works in Barrick favor. And copper demand is also expected to grow as more energy vehicles and renewable energy systems are built. But there are some risks to consider as well, as small percentage of its production comes from places like political changes like Mali and Pakistan. These risks could affect operation in those regions. However, Barrick is well diversified with mines in stable areas like North America, which reduces its overall risk. The fourth stock in the list is Teck Resources. So, Teck Resources is a Canadian company and it's one of the largest and most diversified mining companies. They are focused on producing essential metals like copper, zinc, and steel making coal. And they are also operating in major mining projects worldwide, including Canada, Chile, and United States, making it a global leader in resources industry. They are also perfectly positioned to benefit from booming demand of copper. So let me explain you more about copper. It powers our homes, fuels electric cars, and even support renewable energy. And right now, copper prices has been struggling, but many experts believe that the worst for the copper is over. In fact, this could be the perfect time to invest in copper stock like Teck Resources. So let's start with why copper is important for the world. So copper is used in electric vehicles. They need 4 times more copper than just a regular cars. It also essential for renewable energy projects like wind turbines and solar panels. And it powers data centers and energy grids, which are expanding rapidly. Globally, governments and businesses are pushing for net zero carbon emission by 2050. And to achieve this, we will need a lot more coppers. And many experts estimate that copper demand will grow by 3.5 million tons annually by 2050. This means more copper is needed to build EVs, renewable energy system, and even more infrastructure. And now talking about some risks for tech. So China's slow recovery is one of the risks for tech. China is also the world's largest consumer of copper. Its economy is recovering slower than expected, which is holding back copper prices. And the next is strong US dollar. So strong US dollar make commodities like copper more expensive for other countries, reducing demand in the short run. Now the fifth stock is Nutrien. So they are a global leader in fertilizer and fertilizer are the backbone of global agriculture. So nutrients plays a critical role in feeding the world. So let's start with the basic. Nutrien is world's largest producer of potash. And potash is a type of fertilizer that helps to crop grow. It's also one of the biggest players in nitrogen-based fertilizers and has a massive retail business that sells directly to the farmers. What makes this company special is its low-cost operations. Most fertilizer companies struggle with price drops, but Nutrien mines in Canada are so efficient that they can stay profitable even when the prices are low. So this basically gives Nutrien a competitive edge, allowing it to make money and even grow when other companies are struggling. Now, if we talk about why fertilizers are important, fertilizers like potash, nitrogen are essential for any crop to grow. Without them, farmers can't produce and the world population is increasing day by day. Also, there is always soil replenishment. After a big harvest, soil loses nutrients and fertilizers are very important to restore them. So, farmers are growing more crops than ever now, especially in countries like US, which boost fertilizer sales. Even during tough time like higher inflation or economic downturns, farmers still need to fertilizer to grow their crops. And if we look at their financial performance, in 2024, Nutrien's earning in fertilizer improved. For example, its earning from potash fertilizer went up by 21% in quarter 3. And their dividend, they offer 4.4% dividend. And they have constantly growing its dividend over the years. And there are some big opportunities in the market for them. For example, global grain stocks are low, meaning farmers will need more fertilizer to meet demand. And nitrogen inventories in the US are below average, which should keep fertilizer price strong heading into 2025. Now, these were the 5 stocks that everybody should own for a great dividend and for the future. So, If we talk about the value of Canadian stocks are usually cheaper than US stock. So this doesn't mean they are worse than US stocks. It just means you're paying less money for each dollar for the company earns. And if we look at the PE ratio for the Canadian stocks are lower than as compared to the US stocks. US stocks, especially tech companies, are really expensive because they have been growing fast. So Canadian stocks might outperform US stocks in 2025. And if you find any value from this video, please like this video and subscribe to my YouTube channel.